Certainly, sir. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. Participants are requested to only use handsets while asking a question. Anyone who has a question at this moment, please press star and 1 on your touchtone telephone. The first question is from the line of Atul from ILFS. Please go ahead.
Yeah, hi sir, Atul here. Just a small query. The definition of real estate mentions that mortgage property is prohibited. So just wanted to check your views. Like many real estate guys have mortgage properties. So is it not a roadblocker for them? Thank you.
Yeah, so
not property.
I'll answer that. Yeah, so mortgage properties are not allowed, so you can't buy mortgage. The only within your 10% bracket also, you can only take mortgage-backed securities. And I think SEBI understand that the way ahead would probably be for mortgage-backed REITs, etc. But for now, this is only limited to mortgage-backed securities, that too within the 10% bracket.
Thank you.
Thank you. The next question is from the line of Ashutosh Singh from Cushman and Wakefield. Please go ahead.
Sir, this is Ashutosh from Cushman and Wakefield. My question is there any minimum lock-in period during which the investor is required to invest in the REIT? And then my second question is, how does this have implication on the FEMA? Are FEMA and REIT interrelated anywhere?
I'll answer both your questions. On the investor, there is no lock-in. The only issue is that if you sell before 3 years, you would lose out on the tax benefits. And as regards FEMA and REITs, I think we just discussed that there will need to be a carve-out that needs to be made to allow units of a REIT allowed, and that is more from a foreign investor perspective.
Yeah, the only lock-in which is there is on the sponsor. So 25% of the units held by sponsor will be locked in for a period of 3 years from the date of listing, and anything above 25% will be locked in for a period of 1 year. So it can't happen that the sponsor transfers the property to the REIT, gets the units, and on the next day transfers some of the units to public or to some other investor. So there is a lock-in for the sponsor but not for the other unit holders.
Yeah, and also after the 3 years also, sponsor has to continually hold 15% of the total units throughout.
At all times, yeah.
At all times.
Ms. Singh, are your questions answered?
Thank you.
Thank you. The next question is from the line of Ishan Singh from RE Capital. Please go ahead.
Yeah, hi. I guess what I want to find is what is the timeline for someone to undertake this process, and given the august group of people in this conference, who is the first person likely to get out of the gate? I mean, which is the first Indian entity who's going to list a REIT in India, and what is the timeline they're going to take to do it?
All right.
We don't have astrologers on the panel, but I'll still request.
I think Shobit, you could probably answer on whom do you think should go, which developer, etc. Who has been connecting with you. I think the timeline here should be little lesser. Obviously, I think within 3-4 months, I think you should be able to list. Obviously, subject to the regs, etc. coming out.
But considering that there is October limit before the end of the year, you should expect something.
Yeah. And Shobit, on you on the commercial bit.
I'll try and answer it differently, but my guess is that there are only about 10 or 12 office developers, including DLF, Embassy, Panchsheel, I mentioned earlier, Prestige, etc., who have commercial assets on the balance sheet. Other than that, there are only 2 investors today who have large office portfolios, Blackstone and Brookfield. So my guess is it will be amongst these guys. One amongst these guys will lead the pack. But difficult to predict who's going to be the first.
Nitin?
I mean, yeah, I could see the Indian Express building as the first leader single asset, but the people putting as leading it. I mean, so he's like Shobit, like you just said, I want to see someone go through this process once, and then I get to become clear of everybody else.
Sure.
Yeah, I guess so. Yes.
Can we have the next question, please?
Yes, sure. The next question is from the line of Gandhar Jain from AccuPro Consulting. Please go ahead.
Yeah, hi. I just wanted to understand that commercially how this product is beneficial from a normal lease rental discounting. So we have a product of lease rental discounting in market which is beneficial in terms of the developers to get funds from the market. So how do you think?
So I think Rajesh, you might want to answer this. See, lease rental I think it'll again depend, as we said, where is your investor base, non-resident, resident, how are you capitalizing your REIT? So I think Rajesh, you may want to add
and
from a tax
there are
perspective.
two parts to it, right? One is the fact that over a period, yes, there is a capital appreciation, so you effectively gotten the asset of your balance sheet. So, and then you can go on to your next project. So that's also, so there are certain commercial aspects to it. Obviously, in terms of what are the rates that you're getting between lease rental discounting vis-a-vis if you're actually putting it out in the REIT. So I think you have to look at it as two different products. Each one is looking at a different investor class. In this particular instance, in case of REITs, you're probably focusing more around some of the Indian HNIs, family offices, and anybody who's got deep pockets, and obviously a large pool of non-resident investors. So I would actually look at them as two separate products with two different commercial considerations. Absolutely.
The fact is, we are REITs, so basically what you're talking is equity, right? And LRD is debt. So both are different.
Correct.
So when you take LRD, there is an obligation to repay and repay over a period of time, where these units help them to sort of clean up their balance sheet, deleverage, and sort of move on and pursue growth. I think both are entirely different.
Yeah.
Okay.
Thank you. The next question is from the line of Johnny from Cambridge Associates. Please go ahead. Please go ahead with your question.
Yes, hi gentlemen. Thank you very much for the in-depth explanation on REIT. One question regarding the current taxation structure. Is it still being debated, or is this pretty much finalized?
So this is really the budget proposals. There is a finance bill that has come out. The finance bill will obviously be tabled before the parliament and will be voted upon. There may be some degree of tweaks. Historically, what we have generally seen is that there may be some small minor tweaks to the finance bill before it gets placed for voting. But substantially, it will be similar to what we have in place, which we just explained. Unless there is, let's say, a lot of representation and the government decides to change its stance on a couple of aspects, but you're more or less looking at what seems to be heading towards the final version.
If at all, it will be only an improvement over there.
It will be only an improvement. It can't get worse, that's for sure.
I think the only thing people are hoping is for DDT to go.
Looking from my perspective as an advisor to a number of global LPs here, I mean, it seems that the only way that somebody can optimize the tax is to have some form of a debt instrument as the asset for the REIT. I mean, is that at all possible?
So I think I look at it in two forms. One is that if the REIT is holding the assets through a SPV, I would definitely be looking at a thin capitalization structure, whereby the REIT has substantially invested in debt and very little in equity, so that there is an absolute pass-through as far as the interest coupon is concerned, and you end up with only a 5% effective tax in India. Having said that, again, the question really is that when the capital appreciation aspect comes into play, holding the assets through the SPV, to what extent it is completely optimal is one question that's going to be there. If the REIT is directly holding the assets, you're effectively looking at what I would think at around a 21% tax in India on the rental yield, which is going to be directly distributed to the investors with no tax in India for the investors. So from a non-resident investor standpoint, they will probably get a credit for the 21% tax in India if the REIT is looked at as a pass-through entity. So from that perspective, there is some degree of tax optimization that can come into play for them. As I said, I think what becomes critical for a non-resident investor is whether in the home jurisdiction they're going to look at the REIT as a pass-through entity or as a blocker entity. Because if it's a pass-through entity, once you have a 21% tax in India on the rental yields, which have already come in, there's not going to be that much of any significant tax consequence in the home jurisdiction.
Sure. So I guess it will be dependent upon the bilateral tax treaties that, whoever the foreign country may be with India, right?
That's
yeah, and also the local laws of the jurisdiction from where the investor is investing.
That becomes critical.
That would be more critical than the treaty.
Yeah. Okay. Thank you very much, gentlemen.
Thank you. The next question is from the line of Nitesh from BCRE India Private Limited. Please go ahead.
Hi everyone, this is Rajesh. I have three questions basically. The first is with respect to the sponsor, wherein a sponsor has a minimum obligation of a 15% holding in a REIT. Where is the REIT the minimum value of assets that needs to be held at every time? Is it going to be 1000 CR only? That is number one. The second question is with respect to the yields. As per the GSEC yield rate prevalent in India, it's anywhere between 8.5 to 9 right now. It keeps on fluctuating. However, when you look at REITs which are listed outside and which are based out of India, whether it is F&Rs or both yields are anywhere in the range of 6 to. And you compare it to the prime yields in the market right now for prime income generating assets, it's anywhere between 8 to 9. How can a REIT expect a premium on the prevailing GSEC yields? That's number two. The third question is with respect to the currency fluctuations that an NRI has to see over a longer period of time. I mean, on an average, on a year, if my dollar depreciates 8 to 10%, then how can I expect to make return on it when my yield is only 8 to 10%?
Okay, sure. So I can take the first question.
Okay.
So first question was on the 1000 crore. So currently the way regulations are worded, draft regulations, they provide that at the time of IPO, the value of the REIT has to be only 1000 crores. But I think the way SEBI looks at it is the value of the REIT going forward also at all times should be 1000 crores. So that is the intention of SEBI. There should not be small players. There should be only serious players who enter the REIT market. So I think that is the intention of SEBI.
GSEC question.
Yeah, I can take the second question. I think that's the point I was making, that Indian assets are able to sort of throw up only limited cash yield over the period, and investors have to look at a combination of cash yield and growth coming through rental and maybe through cap rate compression. Just to take off Ascenda's example, why they are offering 5.3% dividend yield in Singapore dollar in Singapore. These 3-year CAGR for Ascenda's India Trust is about 15%, right? Or rather 10% rather. So overall the total return expectation over 3-year period is 15%. So I think that's the kind of rental growth which Ascenda is able to project. Whether they will be able to deliver or not, that's a separate issue. But you will have to sort of offer higher growth and hence meet the total return expectations of the investors.
You want to take the question on exchange fluctuation?
Okay, and exchange fluctuation, yeah, I think that's another issue of when you're trying to list your assets in Singapore, because people look at currency adjusted returns there. Investors who are used to investing in Indian stock exchange, they have the mindset of taking currency risk, so they would be taking that currency risk and adjusting the return requirements, and I think the total return expectations which are being sought in rupee terms are basically set at a level which gives them some protection against currency devaluation.
Sure.
But do you think that REIT would be able to provide us with that kind of returns? Now if I adjust it for currency risk, my institutional yields in the country right now is anywhere between 9 to 10.5%. I adjust currency risk to it, my yield should jump up to around 11.5, 12%. Do you think that REIT would be able to provide those kind of yields?
Yeah, so I think the total return expectation based on our initial dialogue with investor community is about 13-14% overall, which will be achieved through a combination of cash yield of about 6%, rental growth of about 4 to 6%, and balance through cap rate compression. So all these three factors put together will give you 13-14% over say 5-7 year hold period. That should meet the return expectation of these long term institutional investors. They are looking at 13-14% rupee returns from Indian market.
Okay, thank you very much.
Thank you. We take the next question from the line of Ashutosh Hegde from LIC Housing Finance Limited. Please go ahead.
Hi. Just wanted to check out, is there any restrictions on listing of SEZ properties?
Restriction on listing of SEZ? No. You can put that in.
Sorry?
No, there's no restrictions.
Okay. Second question is that is there any lock-in for from the tenants, rental lock-in for the tenants from income-yielding assets?
No.
I mean, if the way, like as a fund, if you look at a property, so look at whether there's a 9-year lock-in or a 8-year lock-in or something of that sort.
No, there is no lock-in. There is no lock-in. The only thing is
that's a manager's call or a commercial
that you need to, but you need to ensure that as a REIT, 75% of your area is always leased out. Otherwise, you are in trouble from SEBI.
And it will affect your marketing and pricing of the REIT.
Yeah. What happens after it is listed? 75%. I mean, 5%.
I think Ruchir mentioned there's no cure at the moment.
So currently there is no cure period, but I think SEBI was considering a 6-month cure. So let's see what comes out in the final regs.
Okay, thank you.
Thank you. Next question is from the line of Ketan Shah from Primary Advisors. Please go ahead.
Yeah, hi. Just wanted to have clarification on this relaxation in FDI guidelines in terms of area and capitalization. Is it across all FDI investment or is it restricted to 100 smart cities?
No, it's across all.
It's across all. I know the budget statement, if you look at it, it said in order to build 100 smart cities, I am doing blah blah blah. But I think it is for everything. There is no specifically for the 100 smart cities that may or may not come up.
Yeah.
It's not for that.
Smart cities cannot be of 20,000 square meters.
Okay.
Thank you.
Next.
The next question is on the line of Rajendra Prasad from Karvi. Please go ahead.
Hi, good afternoon. Just want to understand what's the possible trading pattern, like if for a small investor, the lot size is 1 lakh and the minimum investment is 2 lakh, it's an IPO. But once it comes onto the listing, how does it go about? Like, what's the expected liquidity and what is the ticket size, like the trading unit?
No, ticket size has already been established at 1 lakh rupee per unit. The idea is that SEBI did not want very small investors. At some point in time later, the ticket size may become smaller, but for now it is 1 lakh only for trading and 2 lakh rupees for subscription.
So, okay, so we can, you have to, whenever you buy or sell unit in the secondary market post listing, it has to be
1 lakh.
One unit.
One unit of
One unit of 1 lakh.
Okay, so it has to be 1 unit of 1 lakh.
Yeah.
So it's basically out of bounds for many retail investors.
Exactly. That's the idea for now.
Yeah. Okay. Any norms on the liquidity, like as in how many number of units should be floated at least, so that.
So basically, offer size, minimum sponsor commitment of 25% is there. So
no, units as in
offer size has to be 250 crores, and what SEBI says is that minimum number of unit holders apart from sponsor has to be 20 at all time. So if it goes below 20, then you have to go for delisting.
And the public float has to be 25%.
Public float has to be 25% of the total units.
And there won't be like for example, when it comes to capital appreciation, as I said, it will be valued only 2 times in a year and 1 time fully.
Yeah, correct.
So the valuation that you do will be based on the discounted cash flow methodologies, or will the valuers use? Are there any guidelines on valuation techniques or methodologies?
So there are internationally accepted methodologies or ICI prescribed methodology. ICI prescribed methodology will prevail over any other methodology. So I think that we've discussed. Maybe we can.
And the NAV, unlike the REMF, will be calculated twice, which the manager will have to do twice in a year.
And sir, any capital gains that we have, how will be the taxation for that? Will it be a pass-through or?
No, there is no pass-through as far as capital gains are concerned. It's going to be taxed in the hands of the REIT, but there is not going to be any tax in the hands of the investors at the time of distribution.
Yeah.
Okay. And what's the tax rate like for the REIT? It's the usual listed securities capital gains that's.
So as far as the REIT is concerned, it will be like the usual listed units that are there. And the only thing is that the holding period is 3 years.
So it will be what talking about the capital gains tax long term?
Zero.
Long term zero.
Long term will be zero, except for the sponsor who unfortunately has to pay a higher tax.
Okay.
All right.
So maybe I think we can open the floor for the audience here.
And we just check how many on the call, or
are there more
how many
questions
questions on the call?
Are there more questions from the
No.
participants joining on phone? Okay, great.
No, there's no one.
Okay, great. So maybe we can have questions from you.
In the case where the assets are transferred to the REIT directly, is there any exemption or this on stamp duty?
No.
They have to pay full duty.
The stamp duty is a state subject. So that's why it's not possible to convince so many states. They are anyways grappling with GST to convince all the
Unless
states.
states actually come up with specific exemptions to
Unless states come up with
all over the
specific
rate.
exemptions.
Yeah.
The form of the SPV, can it be an LLP or it has to be a company? Because it's a foreign investment going into a...
Currently, as things stand, LLP, because of the way the LLP legislation is worded, you can only have a body. You can only have, let's say, a body corporate as a member. REIT, there is a grey area as to whether REIT qualifies as a body corporate based on the status of the trustee. So I think what people are looking at generally is that at this point in time, you're only looking at companies.
And suppose the manager is already a manager of a mutual fund, of a AMC, or a manager of a AIF, manager of a BCA. Can he simultaneously play the role of a manager?
Yeah, should be possible because there is a specific provision under REIT regulation where they mention the manager should link his activities of REIT versus his other activities. So in the same entity, you can house multiple activities. But obviously, you will have to also look at the other regulations. Like in mutual fund, there are certain requirements where you need to go to SEBI to get an approval to do other activities.
Suppose if suppose if a private equity fund who owns a commercial asset, he plans to kind of throw the asset into the pool of real estate, REIT. Now this 15% holding for the fund, a fund may have a limited life of 7-10 years. How would this work?
Yeah, so basically, one is whether he is designated as a sponsor or not. So if he is designated as a sponsor, which he will be if he is throwing the asset into the pool, the requirement is 15%. If there is a change in sponsor, 75% of your unit holders have to approve first. And if the unit holders do not approve, the new designated sponsor, so whenever there is a transfer, the sponsor will have to redesignate a new person as the redesignated sponsor. Redesignated sponsor will have to give an option to the unit holders to sell the units back to the redesignated sponsor. So they give an exit option to the unit holders.
Or the other way can be, as Shobit was mentioning, that the PE fund partners with that developer. And the developer is recognized as the sponsor who continues to hold it, and then the PE firm is free to transfer, etc.
But
so
there is a provision for transfer to another sponsor. So if your fund life is ending, then before the end of fund life, you can find another fund which has just started its life, and it can buy the units.
Yeah.
The REITs is expected to pay 90% of its income as a payout to the investors. I presume it will be a net income.
Correct. Net. Yes.
So is there any cap on what type of expenditure the REIT can debit to the gross income?
So this was discussed, and ultimately it was decided that there should be no cap that should be prescribed. But, and that is why there is obligation on the manager and the trustee to supervise that, and everything should be in legitimate arm's length. It's kept at arm's length. Now what is arm's length, you decide.
Having said that, there is a lot of, there's global practices all around, this kind of income stream or cost structures are already prevalent. So I don't think anybody can now come back and say, I will charge a habit number.
So supernormal.
Supernormal. So my sense is that it's not going to be that's not going to be a money making.
Typically what percentage it works out as a gross?
I think I followed Ascenders. I think the leakage is about 1.5%.
2-3% is typical.
Yeah, just on the direct expenses, and then of course there are other expenses.
And interestingly, the
excluding the fees.
Excluding the fees.
Interestingly, the 90% requirement in a lot of jurisdictions is only for getting a tax pass-through. In India, what SEBI has done is it is a mandatory condition for it to retain its character as a REIT. So in other jurisdictions, they can still retain the money deploy it for acquiring new assets. But in India, mandatorily you have to distribute it to the unit holders.
Whether this real estate SPV has to necessarily own the asset, or it can have a lease asset itself and then it can.
Leasing.
So if I am
Leasehold is specifically allowed here. So there's a specific provision in the REIT regulation.
So now, if I am a real estate developer and I have say 10 associates, I can take on lease 10 properties worth 1,000 crores and then list my company and do it.
So I'll tell you, the leasehold assets has been allowed, but the intent of SEBI is not that you have a 1 year or a 2 year lease or a 3 year lease. These are intended to be long term leases because many times, like in BKC etc., assets, properties itself are on leasehold basis. So it's only as a substitute to conveyance that leasehold has been allowed.
Yeah, it's a leasehold title, not a leasehold property.
Correct.
It's a leasehold title.
Land can be leasehold, but the property has to be owned.
Yeah, it's a leasehold title, which sometimes when you're dealing with the government, the title can only be leasehold.
Correct.
They cannot give you a freehold
title. I think it
title.
will be difficult to put a short-term, even 10-year leases into a portfolio and list that. I think very challenging. You're barring again.
I'm not talking about the challenge on account of investor stability, but I'm talking about from the regulatory.
No, regulatory perspective. So intent of SEBI was not to allow leased assets. It was really because some assets will always be inherently leasehold. It was for that purpose that the provision of leasehold was added.
In fact, the definition of real estate specifically says means land and other attached improvements, whether leasehold or freehold, and includes buildings, fittings, fixtures, and other assets incidental to ownership of real estate. So your structure has to be owned, your land can be leasehold.
And to keep a check, manager has to, when he is acquiring leasehold property, he has to give a report to trustee, has to know what is the remaining period of leasehold, all those.
That will be quite stringent. So you should just realize where you can't own it, it is only in those cases. So otherwise, lease is not the idea.
Yeah.
Coming back to the earlier question where we are talking about distribution of 90% of proceeds income and also the limitation that the REIT has to be 1,000 crore entity throughout its life, it essentially means I cannot sell the property at any point in time. Because the moment I've sold
over the period, right? If you say no, my REIT is still going to be static for long period, again from marketing perspective there will be an issue.
I think just commercially speaking, if you're talking about 1,000 crores,
you're talking about 3-4 buildings.
Not even maybe 2 buildings. So I think the restriction has come from people trying to list out single assets, right? And this just from an exit perspective and keep controls.
There will be a lot of, I'm presuming, in this market.
Any of these 100 billion that we were talking about, I think minimum size would be 6-7 million square feet per listing, right? Or could be even higher, double digits. So I don't think we'll ever be in that situation that we'll be trying to meet the minimum criteria. There's something really wrong if you're trying to be that 1,000 crores and 250 crores of offering at the very minimum.
So here's a question. When you're pricing the REIT at the initial listing, when you're talking about rental growth, incremental rental growth on an annual basis or every 3-year resets that happen here to be clear. When you're pricing it at the time of IPO, aren't you factoring in all of those with the current existing leases in place, that you're discounting it to the NPV and you're deciding what is the value? So where is the increment coming up? There is only a cap rate compression possibility, unless you are pricing it at the today's rental only, without actually factoring in the future lease increases in the leases. Then why would a developer not do it when he has a signed letter which resets incremental rent every 3 years?
Okay. We have to differentiate between the yield and the valuation, right? So one is the cash yield we were discussing, and we are saying that the total return expectation will be met partly through cash yield and partly through growth, right? The valuation will obviously take into account the future growth, right? So that will be captured in the valuation computation. So what I'm saying is that when you buy the asset, you will look at what kind of total return I'll make over the period, capturing the inherent growth.
You're talking about the individual
the sponsor, right now the sponsor.
The sponsor is the actual owner of the REIT. Let's assume that the developer already owns it. So are you talking about him, because he already knows what is there in
right?
Are you referring to the subscriber to the REIT?
No,
investor like myself.
Yeah. So if you're subscribing, right? So what will happen is, you suppose at the time of IPO, the REIT will say, fine, I'll offer you 6% cash yield, right? And you know that because of the leases which have already been entered into, it will give you 4 to 6% rental growth, right? The next year, the yield on your investment price will not be 6%. it will be 6%.
It will not be next year. It will happen only after 3 years. It doesn't every year in typical leases in India.
That's fine. So after 3 years will be 15%, right? So there will be a like one-time jump, and that will impact both the impact the cash yield as well as impact the capital values. Because once you have arrived at a cap rate, you will apply cap rate on the NOI, which will be at the escalated number.
Adib, just to answer it differently, you're assuming that everything that's listed is rented day zero, right? So that's not going to happen.
75% of the property.
Yeah, so you're going to have a staggering of even the increments on rent. So it will happen. Number one. Number two is that.
See, okay, if I take your point also, sorry to cut you, but the thing is, I agree that everything is not listed on day zero, but then there will be small portions, and those will be trickles. Everything is not also listed like floor wise or 25%, 20%, which on the same dates in every year, right? There could be staggering of 3 months, 6 months on every lease.
Yeah.
So it will come in trickles. So it's not an absolute number which will happen every year or every exact reset of the 30.
But you would know that on day zero when you're
I
listing.
agree. So my point was, my question was slightly different. The question is, as a developer, as a sponsor who owns the 1,000 crore rupee asset, how am I pricing it? Am I pricing it on today's rental only? Because as a developer, will I not like to look at when I'm encashing it, and supposing over a period of time, minimum is 25%. I may want my cash requirement to be 75% listing. I may list a 750 crore road and I own 250 crore worth. I tend to lose vis-a-vis, there was a question earlier also, vis-a-vis rental discounting or a large individual investor who is buying from me at today's 10%, who is pricing that 9-year increases today and giving me the money.
No, so even when you buy these assets, it will not be priced on the year zero rental, right? You'll build a 20-year model and see what kind of returns.
You can't build 20-year models in India. Sorry,
Sorry. So I think these are how the
nobody has
done.
done it historically. So let's say 10 years. That is what is real.
Well, 10 years, 20 years, whatever it is. Like so when I say 20 years, basically that's a long-term horizon. So basically you look at 10 years and you look at what kind of returns the assets will generate, and accordingly you price it.
Also, we've been sort of advising even on the private side, even where you have long-term contracts, right? In India, typically your lease contracts are 9 years. There are either unleased areas, or after the lock-in, you assume there will be a re-rating because the tenants will shift. It is not necessary that your rental for 9 years is predetermined.
So vacancy risk, all the
vacancy risk, re-rating risk is there, and therefore you assume there will be some growth. So my sense is that you can, and when you have variety of portfolios or different buildings, it's in fact that risk is reduced, and therefore listing a portfolio, this question will not be asked. But yeah, if it's a single asset, then I'll be challenged.
I mean, there is an asset very close to where we are sitting, which is 1200 crore rupee asset. It's a single asset.
Yeah, it's a single asset. Single asset, you'll have an issue.
You list that,
but yeah,
you have an issue on that.
But like I said,
all parameters, but yeah, you can face that.
Therefore, the unit price will fluctuate every day.
No, they
should not fluctuate too much. It should not fluctuate too much.
Won't too much.
Because at any point 75% is anyways leased. You can't have less than 75% leased. So the variation will only be 25%.
I am a unit holder who has acquired a property in say BKC, not BKC in a upcoming suburban area. Now all of a sudden the area has changed, and therefore the value of the property is appreciated from say 1000 crore to 2000 crore in a year's time. So the entire game will change. The lease rental may not be changing in terms of the.
It should get reflected in the pricing of the unit.
But the value will change. Value will change. That is why you have two valuations, not a daily NAV, but yeah, you will have, because property value does not change every day, but yeah, over a period of time, over 6 months, you will change your value.
So the investor will be able to exit only in 6 months. So
he can exit anytime. He can exit anytime, but the valuation will be reset every 6 months.
Every 6 months.
So for the 6 month period, you take a call.
And you can add more assets to the same listed REIT?
Yeah.
You can keep on adding. So then here's the question from tax angle. Because if you intend to do that for large developers, also who will have continuous flow of such assets, what would be your recommendation from a tax perspective? Should they look at putting structures of SPV, ownership by REIT, or shares of REIT from a long-term view to have the best taxation structure so that investors are benefiting?
So there are 2 points there, right? As in the question is who's getting benefited. That's as to whether it's a sponsor or an investor.
There is no more sponsor perspective.
I think he's wearing the sponsor hat.
So from a sponsor hat, if I look at it, obviously, if my call is that there is going to be a future appreciation, I don't, subject to obviously cash flow and everything, I may even consider, can I transfer today and pay tax at today's value, but I'll get the capital appreciation at the later point in time. I get the step up in basis and all of that. That's one call that they can take. The second call is that transferring the asset directly into the REIT versus transferring shares of the SPV that will be there. And here you need to look at it from two perspectives actually. You cannot just look at it from sponsor, because ultimately the question is, is the REIT marketable or not? There, if ideally my ideal situation is always, if I am having a SPV, REIT should be having a thin cap structure, which means that there is only, let's say, a 10% equity, rest of it is debt. So if I can manage, if a sponsor has already set up a SPV today for, let's say, a lot of enough development assets are around. So if the current SPV structure already enables that, then it is easy for me to actually transfer that out into the SPV. Otherwise, there has to be some degree of restructuring that needs to be done if I'm transferring the SPV, or post transfer I have to do some degree of restructuring to get to my ideal structure, which will benefit the investors also. Because if I don't give enough on the table for the investors, they're not going to pick it up. The third thing is, okay, do I transfer the asset directly into the REIT? Well, in some cases, obviously, if the sponsor is holding the assets directly, he doesn't, because otherwise I have dual incidence of stamp duty. If I transfer it into a SPV and then transfer it out, I have enough stamp duty issues which I have to think about. So from a cost perspective, it doesn't make sense for him, but to transfer it directly into the REIT as the assets. So that's broadly when I'm looking at it from the sponsor perspective. Though as I said, there are two calls that are there. One is that, can the sponsor take the position that the settlement of the property or the assets should not be taxable under the general trust law provisions, rather than relying on the specific exemption which they've given, because in that case, then when he is subsequently selling it, he gets the capital gains tax, the long-term capital gains tax exemption. That is one call that is there. From an investor standpoint, when I look at it, is the investor better off with the REIT holding the assets directly or the REIT holding it through the SPV? In most cases, as in just a back of the math envelope calculation, seems to indicate that in all probability, if you have a whole bunch of non-resident investors, you're probably better off holding the assets directly. If you're having resident investors as your target class, then I'll probably look at the thin cap structure, the SPV structure also working out. So to a large extent, it depends on who my target audience is when I'm marketing the REIT. And depending on that, I'll sort of work out on the structure that would probably be appropriate. Because even for non-resident investor, I have to see where are they going to be coming from? Are they coming from Singapore? Are they coming from US? Am I marketing it to Japanese investors? It depends. Because each one, because you're looking at an animal, when I talk about the REIT, as to each jurisdiction, will look at the Indian REIT differently. So I need to look at it from that perspective as to who am I marketing it to? Who are the people who are going to want to invest here? And depending on that, I have to do the structuring, whether holding it directly vis-a-vis the SPV.
Great. So I think we can take any more questions offline. Maybe last question.
Provision in another REIT, and what are the provision when you have to incur major repair and maintenance for a building for say 10-15 years? You have to renovate the entire thing. So from where the funds will come and how you will also.
You want to take it up?
Deepak, you want? So what is the first part of the question?
So basically the gearing is 25%.
So in terms of leverage, 25% the REIT can take without approval, up to 25% of the total value of the REIT. Beyond 25%, if they want to take,
and
they can go up to 50%, subject to unit holders' consent and credit rating. So that is in terms of leverage. Now the second question is maintenance. Obviously, one is from the lease rentals. If the resource is sufficient, they can use also the lease rentals
from the reserves that you reserves accounts that you have.
Exactly.
You'll keep a reserve account.
And by the way, for the first time that they've been generous enough to say ECB will be allowed for REITs. So you can get very cheap leverage from offshore. But that's budget sake. I don't know what guidelines did RBI prescribe and what conditionalities does it come with. So that's another source other than your accruals, etc.
So last question, what 99% of the developers in India who are who has a property on lease will not be, they would have not leveraged it. I mean, you cannot have a developer who have not leveraged the property. So then, can I just not infuse the money into that SPV rather than shared getting transferred and assets getting transferred, infuse the money in the SPV and the debt getting repaid?
No, absolutely.
So then for
Absolutely. So this is what we discussed, right? That to tax optimize, one of the ways could be for you to inject debt. If you have existing debt, you retire that debt. If the sponsor wants money somewhere, then you retire equity, do a cap reduction. So there are different models, but clearly debt is one of the best ways, because then that's the only way of pass through, and that too at a 5% optimized tax.
The question is therefore that for a limited period, that mortgage based asset. So if the asset is mortgage, can there be any delay or how?
No. So that is fine. Your asset can have certain amount of loan on that, right? That is okay. What they have prohibited is that you cannot only buy mortgage-backed securities or only mortgages. Your asset can obviously have mortgage, so long as you're within the overall 25% seen on a pass-through basis, it's fine.
So in the utilization of the proceeds, you will anyways mention that the funds raised by the REIT will be used to retire the bank debt. So to that extent, that should be okay.
So if I have taken a lease rental discounting today from say Standard Chartered Bank, I can just take the money, increase the money, take money and pay that bank in.
Yeah. You can do that.
Okay,
that would
so
probably be the most common thing.
with this, we'll close the panel, and thanks to all the panelists for your valuable insights and to the audience for the interactive discussion. Thanks a lot.
Thank you for being here. Thanks.